Welcome to the deep dive. Today we're unlocking a really powerful, maybe often overlooked corner of the investment world.
hmm
While many of us automatically think, stocks, bonds, maybe some real estate for our portfolios.
Usual suspects.
Exactly. But natural resources, agricultural goods, energy, what we call commodities, well, they can be a surprisingly vital component.
Absolutely.
Our mission today is to really uncover how these fundamental goods can act as a powerful shield against inflation and a savvy diversifier for your investment strategy. Okay, let's unpack this.
What's truly fascinating here, I think, is that commodities aren't just about the prices you might see at the gas pump or in the grocery store. Not really.
Right.
They represent something more fundamental, a sort of foundational layer of the global economy. And understanding them, well, it can really help you navigate periods of uncertainty, protect your purchasing power.
Yeah.
We're going to pull back the curtain a bit, show how these assets behave so differently from traditional investments, especially, when markets get turbulent.
Precisely. It's like seeing the economy's raw engine, isn't it? So to really dive in, let's get down to brass tacks. What are commodities, fundamentally?
Right.
At their core, they're goods that are more or less uniform, same quality, same utility, pretty much regardless of where they come from.
Standardized.
Think about it. When you buy an ear of corn or maybe a bag of wheat flour, most of us don't really care much about the specific farm or mill, do we?
No, not at all.
That uniform quality is key. And our sources, they break them down into three main categories.
That's right. And recognizing these categories is pretty crucial because it helps us understand their market dynamics, how they're regulated, who's trading them.
Okay.
So first up, we have agricultural commodities. These are products directly from farming and livestock. Wheat, corn, soybeans, cotton, even live cattle.
The basics, food and fiber.
Exactly. And given their immense importance for, well, our food supply and economic stability, they are heavily regulated. The CFTC, that's the Commodity Futures Trading Commission, they're very active here, ensuring fair trading, trying to mitigate market manipulation. Key players, you've got farmers, big food producers, and of course, commodity traders.
Makes sense.
And you'll often hear these referred to as soft commodities, mostly because they're grown or raised and often have a finite shelf life.
That makes perfect sense. Vital stuff needs regulation tied directly to what we consume.
Yeah.
Okay, so what's the next category? How do they compare?
Okay, our second group is exempt commodities. Now, these are physical goods that fall outside agriculture and purely financial stuff. We're talking metals.
Gold. Yeah.
Gold, silver, copper, yeah. And energy products, crude oil, natural gas. These markets tend to have, let's say, less stringent day-to-day regulation compared to ags.
Okay.
But the CFTC still keeps an eye out, mainly to prevent fraud and ensure transparency. This flexibility often allows for more dynamic trading.
More volatility, maybe?
Can be, yeah. The participants here are typically metal and energy producers, industrial consumers who need these raw materials, and, again, traders. These are your hard commodities.
Hard commodities.
Right.
Because you dig them up or drill for them.
Pretty much. Mining, drilling, extraction. And they tend to last a lot longer than, say, a bushel of corn.
Ah, okay. So we're talking about the tangible assets, the backbone of industry, construction, plus the energy fueling it all.
Got it.
And the third type.
The third category is excluded commodities. Now, for this deep dive, like we said, our main focus is on those physical ones, ags, metals, energy.
Right, the ones you can theoretically touch.
Exactly. But it's good to know this other type exists. Excluded commodities are primarily financial products, things like interest rates, foreign currencies, stock indexes.
Oh, so more abstract.
Very much so. They're traded predominantly in derivative markets, futures, options, and yeah, the CFTC regulates them too, mostly for market integrity, preventing systemic risk. But for shielding your portfolio with tangible stuff against inflation and market swings, we're focusing on the first two groups.
That's a really clear breakdown, thanks. So with that foundation, the big question for you listening is probably, okay, why should I care about oil or wheat in my investment portfolio? And this is where it gets really interesting for your financial well-being. Our sources hammer home diversification as a core benefit.
Absolutely key.
We're talking about their tendency to move independently, sometimes even negatively compared to stocks and bonds. This low or even negative correlation. What does that really mean in practice?
It means that when your traditional investments, your stocks and bonds, are struggling, commodities can sometimes follow a completely different path. They might hold steady or even gain value.
So they zig when others zag, sometimes.
That's a good way to put it. If we connect this to the bigger picture, history shows commodities often shine precisely when traditional investments falter. This independence isn't just theory, it's about spreading risk effectively in your portfolio.
Okay, examples.
Sure. Consider the recent inflation surge, 2021 to 2022. The Bloomberg Commodity Index. It made significant gains. Meanwhile, the S&P 500 fell 19.44% in 2022.
Ouch.
And bonds weren't much better. The Bloomberg Aggregate Bond Index dropped 13.02% that same year.
Wow, that's a stark contrast. Really underscores that counter-cyclical potential.
Yeah.
But I wonder, is that always reliable? Or is it mainly during those big stress periods?
It's a fairly consistent pattern during periods of major market stress or high inflation. Yeah. Though, look, no investment is a perfect mirror image, right? Nothing's guaranteed.
Sure.
But another classic example that highlights this is the stagflation of the 1970s. Remember that?
Vaguely. High inflation, stagnant economy.
Yeah, exactly. Rough times. And during that period, commodities delivered positive real returns. They actually gained purchasing power. Stocks and bonds lost it.
So a historical lesson that really rings true today, especially with recent inflation worries.
Definitely. And it's not just during crises either. Even in, let's call them regular economic cycles, commodities often provide positive returns when the economy is shifting gears, transitioning between growth and contraction phases. They offer this unique dynamic traditional assets don't always capture.
Okay, so that leads directly to inflation protection. What does this all mean for your purchasing power when prices start climbing? How specifically do commodities act as that shield? Because that's a huge concern for people right now.
Yeah, it is. And they're intrinsically linked to inflation, which makes them a potent hedge. Several reasons. First, there's a very direct relationship.
Yeah.
Many commodities are the raw materials whose prices are rising. They're literally part of what's causing the inflation number to go up.
Right. So the cost of oil affects transport, production.
Everything. Wheat prices affect food costs. So when their prices increase, that is inflation in many fundamental sectors. Your commodity holding is going up, essentially, with inflation.
So they're not just reacting, they're often part of the cause. Their value inherently rises with inflation, a direct protection.
Precisely. Second, you've got precious metals, especially gold. Historically, they've provided tangible assets that tend to maintain value when the purchasing power of the dollar or any currency declines.
The classic store of value argument.
That's the one. Been seen that way for centuries, really. And finally, there's a really interesting hedge against dollar depreciation. This is important for U.S. investors.
How does that work?
Well, most major commodities globally are priced in U.S. dollars. So when the dollar weakens against other currencies, those dollar-priced commodities become cheaper for buyers using stronger currencies. This can increase demand from foreign buyers, potentially pushing prices higher.
So even as my dollars buy less generally, my commodity investments priced in dollars might actually go up because foreigners are buying more.
Exactly. It means your commodity holdings can gain value as your domestic currency is depreciating. It effectively helps offset that loss of purchasing power in a way few other assets really can. It's quite a multi-layered protection when you think about it.
That's a fascinating mechanism, especially that dollar angle. Okay, but it's not just about inflation, you said. Commodities also react differently as the economy cycles through its ups and downs. How do they typically perform across those different stages? And how could you use that knowledge?
Right. This cyclical performance is incredibly insightful for, let's say, strategic portfolio management. The sources break it down pretty clearly. During expansion phases, when the economy's humming along.
Growing?
Yeah, growing strongly. Industrial metals, think copper, aluminum, along with energy products, often outperform, which makes sense, right? Growing economy needs more building materials, more fuel.
Logical. Okay, what about when things get maybe a bit too hot at the peak?
When the economy hits its peak, things shift a bit. Agricultural commodities frequently excel then, often because inflation expectations are really starting to solidify and people are paying more for food, for staples. Demand stays strong.
Interesting. So as things overheat, farming products can shine.
Okay.
Then the inevitable slowdown, the contraction.
In a contraction phase, when things are slowing down, maybe heading into recession, that's when precious metals, particularly gold and silver, typically provide downside protection.
The safe havens.
Exactly. Investors often flock to these assets when economic uncertainty spikes and their appetite for risk drops. Then finally, as the economy bottoms out and moves into recovery.
Starting to pick up again.
Right. Base metals and energy usually lead the charge once more. Economic activity rebounds, demand for raw materials kicks back in. Understanding this cycle-by-cycle behavior gives you real insights into how you might strategically tilt your portfolio to potentially benefit from, or at least protect against, these different economic environments.
Super useful framework. Okay, so now we know why commodities can be valuable diversifiers and inflation hedges. But maybe you're thinking, okay, great, but do I really need to buy a barrel of oil? Or like a whole silo of wheat?
Huh. Probably not unless you have a very understanding spouse and a lot of space.
Right. The good news is there are several ways to get exposure, and thankfully not all of them involve needing your own warehouse. Our sources lay out about 4 main methods.
Indeed. The first one is direct investment. Pretty straightforward concept, but like you said, it's really out of the question for most individuals when we're talking bulk goods like corn or crude oil. The logistics are just prohibitive.
A nightmare.
However, it is quite doable for certain metal commodities, buying physical gold or silver bars or coins. Storage there is much more manageable.
Okay, so if you're a serious gold bug or silver stacker, direct ownership is an option. But for a broader range, and for those of us without a vault, what's next?
Right. For broader exposure, commodity futures contracts are a very common avenue, especially for professionals. This basically involves agreeing to buy or sell a certain amount of a commodity at a specific time in the future at a price agreed upon today.
Sounds a bit more complex.
It is. You typically need a special margin brokerage account. This lets you control a large contract value with a relatively small amount of capital upfront leverage, basically. Historically, these contracts were huge, designed for big industry players.
Like,
Well, a standard gold futures contract, for example, is for 100 troy ounces. As of, say, late May 2025, that's worth around $330,000. That's way more exposure than the average investor wants or needs.
yeah, just a bit.
But the good news is the market's evolved. Any newer contracts are designed to be much more accessible for retail investors. For instance, the CME Group now offers a 1-ounce gold futures contract worth about $3,300, and the initial margin, the capital you need to put up, might only be around $150.
Oh, well. Okay, that's a massive difference. Much more manageable. But still, futures trading requires some know-how, right? What's maybe the most popular method for everyday investors?
That would almost certainly be commodity ETFs or exchange-traded funds. Super popular.
Right, like buying a stock.
Exactly. Many retail investors choose ETFs because they're easy to buy and sell on regular stock exchanges, just like stocks, throughout the trading day. How they work varies a bit. Some commodity ETFs actually buy and store the physical commodities.
Like actual gold bars in a vault somewhere.
Precisely. Others use futures contracts to track the prices. You can find broad-based ones covering a whole basket of commodities. Examples: the Invesco DB Commodity Index Tracking Fund, ticker DBC. It tracks an index of 14 different commodities.
So diversified right out of the box.
Yep. Or there's the iShares GSCI Commodity Dynamic Roll Strategy ETF, COMT. It uses a specific rolling strategy for its futures contracts. That's designed to manage the costs and complexities that come up when futures expire and need to be replaced, trying to minimize, potential drags on performance from that process.
Okay, that sounds useful. Any others?
There's also the Aberdeen Standard Bloomberg All Commodity Strategy K1 Free ETF, BCI. That gives exposure to over 20 commodities, and the key there is K1 Free.
Why is that important?
Some commodity funds, especially those structured as partnerships, issue K1 PAX forms instead of the standard 1099. K1s can make tax filing significantly more complicated for many investors, so a K1 free fund avoids that headache.
Yeah, huge practical benefit for tax time. Okay, so those are broad funds. What if you want to focus on a specific area like metals or agriculture, or even just one commodity like gold or oil?
Absolutely possible. There are broad sector ETFs too. For example, the VanEck Vectors Gold Miners ETF, GDX, gives you exposure to global gold mining companies, or the SPDR S&P Metals and Mining ETF, XME, for a mix of mining companies.
So investing in the company is not the commodity itself.
In those cases, yes. For agriculture, you have options like the VanEck Vectors Agribusiness ETF, MOO, again focusing on companies in that sector. And then for specific commodities, you have very popular funds. SPDR Gold Shares, GLD, is probably the most famous. It's the largest ETF backed by actual physical gold bullion.
Okay.
For oil, there's the United States Oil Fund, USO, which tracks crude oil futures. For corn, Believe it or not, there's the Tucrium Corn Fund, Corn, and for silver, the iShares Silver Trust, SLV, which holds physical silver. These offer really targeted exposure, but with the ease of trading a stock.
That covers a lot of ground. Seems much more accessible than futures or physical storage for most people.
Yeah.
Okay, what was the fourth option?
The fourth method is investing in commodity producer stocks, which we touched on with some sector ETFs. But you can also just buy individual shares of companies that produce, process, or transport commodities.
So instead of owning gold directly or a gold ETF,
Right.
you own shares in, say, Newmont Mining.
Exactly. Or instead of USO for oil, you might buy shares in ExxonMobil or Chevron.
That sounds pretty intuitive, maybe the most familiar approach for stock investors. But I imagine there's a catch, right? I mean, Exxon's stock price won't always perfectly track the price of oil, will it?
That is the crucial caveat. You're absolutely right. While these companies' fortunes are certainly tied to commodity prices, higher oil prices are generally good for Exxon. Their share price won't necessarily track the commodity one-to-one.
Why not?
Well, company-specific factors come into play. Things like management decisions, how much debt the company has, how efficiently they run their operations, exploration success, hedging strategies, even just broader market sentiment towards stocks versus commodities can make the share price diverge.
So it's an indirect exposure with extra layers of company risk and market risk.
Precisely. But it's still a very viable and very common way for investors to get indirect exposure. You have huge integrated energy companies like ExxonMobil, XOM, Chevron, CVX, BP, exploration and production focused ones like ConocoPhillips, COP, or EOG Resources, EOG, oilfield services like Schlumberger, SLB, or Halliburton, HAL.
Lots of choices in energy. Metals, ag.
Similar range. In metals and mining, you could look at globally diversified giants like BHP Group, BHP, or Rio Tinto, RIO, major gold miners like Newmont, NEM, royalty companies like Franco-Nevada, FNV, copper producers like Freeport-McMoRan, FCX, or Southern Copper, SCCO, and for agriculture, you've got big processors like Archer Daniels Midland, ADM, farm equipment makers like Deere & Company, DE, or AGCO, fertilizer producers like Nutrien, NTR, or Mosaic, MOS. Lots of ways to play it through equities.
Okay, so quite a menu of options, ranging from very direct physical ownership all the way to indirect exposure through company stocks. But like any investment, there are always risks involved. What should you really keep in mind before jumping into commodities? What's that typical risk and return profile look like?
Yeah, it's really important to understand the risks. They're not insignificant. Generally speaking, commodities typically exhibit higher volatility than stocks or bonds.
Meaning bigger price swings up and down.
Exactly. Their prices can swing quite dramatically, quite quickly. Statistically, they tend to have a higher standard deviation, which is a common measure of risk. And as we discussed with the economic cycles, their returns can also vary dramatically based on those broader conditions.
That's cyclical performance.
Right. It means they aren't really a set it and forget it's kind of asset class for most people. They can require a bit more attention, maybe more active management, depending on how you invest.
So definitely not for the faint of heart, perhaps. But those diversification benefits we talked about sound really compelling. Given the higher volatility but potential diversification, how much of a portfolio are experts typically suggesting someone might allocate? Is there a rule of thumb?
Well, rules of thumb are tricky. It always depends on your individual situation, your goals, your tolerance for risk. But our sources do provide some helpful examples, kind of like allocation bands based on risk profile. For a more conservative investor, maybe someone just dipping their toe in, they might look at a 3% to 5% allocation, maybe focusing on, say, gold ETFs and some blue chip commodity producer stocks for a potentially more stable entry point.
Okay, a small slice. What about moderate?
For a moderate risk tolerance, you might bump that up to maybe 5% to 10%. Here, you could use a mix, maybe a broad-based commodity ETF for general exposure, plus some sector-specific ETFs or stocks in areas you feel strongly about.
Got it. And for someone more aggressive?
An aggressive investor, someone comfortable with more volatility and maybe seeking higher potential returns from the asset class, might consider 10% to 15%, or perhaps even a bit more in some cases. This could involve using futures contracts, more focused or leveraged commodity ETFs, maybe stocks of smaller, growth-oriented producers.
So quite a range depending on your comfort level.
Exactly. But the key takeaway, and this is really important, despite their individual volatility, adding even a moderate commodity allocation, say, in that 5–10% range to a traditional stock and bond portfolio can actually reduce overall portfolio risk.
Because of the diversification effect.
Precisely. Because they often don't move in lockstep with stocks and bonds, they can smooth out the ride for the portfolio as a whole. It's about optimizing the entire mix, not just looking at each piece in isolation.
Fascinating. Okay, so wrapping this up, what does this all mean for you listening right now? It really means that commodities, yeah, they can be volatile, but they offer this truly unique counterbalancing effect in your portfolio. They often do well precisely when your traditional investments might be struggling.
Resilience.
Exactly. They're not just about oil barrels or bushels of wheat. They're about building resilience, protecting against inflation, and providing a distinct pattern of behavior, especially during market stress. It's really about building a potentially stronger, more robust financial future by looking beyond just the usual suspects.
And maybe this raises an important question for you to consider, just to mull over. In a world that seems to have increasing economic uncertainty, shifting global dynamics, how might a thoughtful, appropriate allocation to commodities strengthen your portfolio against unforeseen challenges? How might it truly diversify your financial future, maybe beyond what you currently imagine? Perhaps it's time to reevaluate what diversified truly means for your own investments.